The 2025 third quarter earnings season has just officially begun, with positive growth expectations for the S&P 500. Now, while tech, finance, and energy sectors have seen positive revisions, other sectors like medical and transportation are facing some pressure. Our research director, Shraz Mian, is here now with a preview of what to possibly expect this earnings season. Shraz, let's try to start on a positive note. What is the earnings growth expectations for this time around compared to last year?
So, Terry, 6.5% is the earnings growth expected. This will be the lowest growth pace if we get it uh, in the last 2 years. So a fairly decent growth deceleration relative to what we have been seeing in recent quarters.
What about revenue growth expectations?
So pretty much all of that earnings growth is coming from revenue growth. So 6.5% earnings growth and 6.5%, 6.4% to be precise, revenue growth. So about even top and bottom line growth in Q3.
What about margins?
So margins are essentially flat if we look in the aggregate for the index as a whole. If you look at it on an ex finance or ex energy basis, then there is either a very modest expansion or maybe modest contraction. But on the whole, since all of the bottom line growth, 6.5%, is coming from revenue growth, uh, margins are essentially flat from the same period last year.
What are going to be some of the key factors to watch for?
So one thing I have consistently been spotlighting, Terry, for our audience is the somewhat unusual positive revisions trend, and you alluded to that too in your intro. For some of these key sectors, the tech and energy and finance, uh, and it's unusual because in the post-COVID period, the pattern, and you remember this in the pre-COVID period as well, the typical behavior of estimates would be to go down. Uh, Unlike that, we saw positive estimate revisions in the aggregate. And as you rightly noted, that some of these key sectors enjoyed positive revisions, many others suffered negative revisions. So, one key development and trend I'm very curious about, which will have implications for stock prices and the market, as to whether that positive revisions trend continues. Uh, and it will either confirm the very strong stock price momentum we have been seeing, or it will be a big shock and disappointment for investors.
As far as guidance goes, how many companies have issued positive guidance over negative?
So it's been about even, Terry. 50 plus companies, I want to say about 55, 57, issued positive guidance. Roughly the same number have issued negative guidance. So we have a fairly even split on the guidance front as well.
Now, the big banks have reported already the revenue from those big banks was expected to climb going into this earnings season. Did that happen?
Yes, it's been, as you know, it's early going. And we have most of these big Wall Street firms, the bulge bracket firms, have reported, and the numbers are impressive. It's very strong bottom line growth. On the whole, positive commentary about the economy, about the health of consumers, and on and on, a pretty positive start to the earnings season, and a fairly upbeat outlook for the coming periods as well.
As far as I could tell, deal making was a big catalyst for the big banks. Is that what I see correctly?
That's right. Yeah. So when coming into the year, Terry, and this was, as you know, uh, on the back of President Trump's election, there was this expectation of deregulatory changes and more market friendly changes that will bulk up deal flow and investment banking activities. We didn't really see a whole lot of that in the first half of the year. But even then, the qualitative commentary from management teams was of good conversations that these bank executives were having with company managements, and what they refer to as the deal pipeline, they were saying was very healthy and improving relative to recent years. So we started seeing evidence of that in these early results, that deal making after a pretty extended period of not much activity has started driving business for these companies. And yes, so deal making has emerged as a major contributor to earnings and top line growth for these banks.
Now, we're still in the early going here, but do you think AI is going to continue to help the tech stocks stand out this earnings season?
Yes. As we were noting earlier, Terry, uh, the tech stocks and the tech sector as a whole has been enjoying positive estimate revisions. The growth, the earnings, and the top line growth expectation has been, the performance has been very impressive in recent quarters, and that's expected in Q3 as well. So yes, it's all of these positive, favorable developments tied to the AI investments. That's the all the buzz around tech is about, and I would expect that that trend to be confirmed by the results, and also by management commentary for the coming periods as well.
So, overall, do you expect this earnings season to be positive for the market? If so, why?
I believe it will be positive, and I think it'll confirm uh, the very strong momentum we have been seeing in the stock market. And the reason for that is that uh, even though the cycle, the expansion cycle in the economy has been fairly long lived, and we have been enjoying, the economy has been enjoying, and the labor market has been enjoying the benefits of that, and we have been seeing the effects of that in pretty robust corporate profitability as well. My sense is that a lot of this hand wringing and worries about the outlook, the impact of the administration's tariff policies, immigration policies, and other unorthodox international relations, uh, the worry that that will have a negative bearing on economic growth will prove just that. That it'll remain just a worry, and we won't see a direct negative effect on the economy or in earnings. I think the secular momentum we are seeing in the tech sector, and then the deregulatory policy thrust of the administration will be more than sufficient to offset any negativity coming from those policy changes, and on the whole, should give us very strong earnings growth, which will be validatory for the market and the strong gains we have seen in the market this year.
All right, I want to remind our listeners that they can keep up to date with earnings trends in your written commentary, and that's accessible on the homepage of Zacks.com. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.